Okay. I was just confirming that yeah, whether we are live or not. Okay. So I hope like yeah, we are live with the proper yeah preparations going on for the upcoming exams. So I hope everyone is doing well and your preparations are on for your upcoming paper and you are mentally, physically and emotionally ready for your paper with good revisions, as an amount of good revision, not just good revision, with the paper solution, with the good health, yeah students. So I really wonder you all that please do take care of yourselves also, and yeah, for exams now, please don't get like the anxiety should not be there. Okay, you should be confident, not anxious basically. Otherwise whatever concepts you are good with, maybe even that can be a problem. Okay, yeah, so I hope our revisions, our plannings are going on. Yeah, so okay, so today is being our fourth day of the revision series. So yeah, without any further delay, I know we have already started up with our chapter which was known as financial instruments. A lot of concepts have already been done in the financial instruments also, and I hope that you guys would have watched the previous session also, which was basically very important. Yeah, which was very important because I know, as I explained you in the first question, when you talk about the first question, which is again compulsory, which comes from consolidated part, definitely you will be figuring it out like one of the adjustments or one of the questions which talks about financial instruments. So yeah, a lot of students are having a doubts for financial instruments. So yeah, kindly watch session YouTube number third day's revision series. And yeah, today we'll be completing financial instruments and moving ahead towards the very cute and the easiest concept which is known as ratios. And then maybe time permits how we'll take up. Like we can take up some important questions, as and when what I thought of was doing the important questions later. But along with the concepts only I'm taking it up. And yeah, for tomorrow and day after tomorrow, we'll be starting with the most important topic, which is known as the mock paper solution. So yes students, without any further delay, let's just start. Okay, so I hope you are able to see the financial instruments. So students, what are the concepts which we have already covered? So yeah, if I just brief you out things, we have already started our financial instruments, and in financial instruments we know students that we have three standards. Yeah, we have three standards. Agreed? Now which were the three standards? So ma'am, we had IAS 32. Yes. We had IFRS 9, and we have a small concept of IFRS 7, which first of all talks about disclosures, which are very simple. In IAS 32, we understood the meaning of what? Meaning of first of all the financial instrument, understood the meaning, the classification, the understanding of the concepts, which is known as financial asset. Then we understood financial liability and equity. Yeah. So for one party, if it's a financial asset, for some other it needs to be either a financial liability or equity. So that is known as financial instrument. So students, in the last concepts, we have covered some questions related to that also. And in that, I told you in IS 32, the most important concept which comes up here is compound financial instruments. Yeah. So it's compound financial instruments, which is something like in the question you will be getting something, for example, like a convertible thing. Yeah, it's a convertible, either a bonds, preference share or anything, or debentures. If that convertible debentures wants to get converted into what students, into what? Maybe in the upcoming future, if it wants to get converted into equity or something else, like equity only, huh? And it is at the option of whom? So if it is at the option of the holder, like in future, if I want to convert my preference share, I can convert it. If I don't want to convert, I will redeem money. So the issuer of the like the preference share or the issuer of the bonds which are convertible has to first of all book, like where I will consider that person's name to be returned. Like is that the liability of the company? Is it a financial liability of the company? Or if it's not a financial liability, then is it an equity? So where should I record that? So for proper recognition, we have learnt about the concept which is termed as compound financial instrument. So we get to know that where it is compound financial instrument, it is having both the concepts. Some concept of asset that is some concept of equity portion, that is the components. So in the compound financial instrument, students, we have understood that it is bifurcated into two parts. Like there are two components in that. So which are the components? Yeah, so they'll be having some initial liability component, and another component is known as equity component. And yeah, we have bifurcated as per that. Now the most important thing which may come in our paper turns around to be IFRS 9, which if I tell you, it's bifurcated into recognition and derecognition, then measurement of whatever the financial asset liability, because in this recognition derecognition we can identify financial asset, financial liability and equity, we can recognize it. Then at what value are we going to measure it? Even that is something which we saw yesterday. In the measurement criteria, students, we know that my financial asset is measured into how many parts? Yeah, perfect. I cannot put it like with maybe black, I can write it. Okay, my financial asset is bifurcated into three parts. Yes, that is amortized cost, then fair value through OCI, and fair value through P&L account. Students, my humble request, if someone has any sort of doubts in this topic like IFRS 9, students, it will not take more time. It will hardly take 1 hour, or not even that much. It was not just even 1 hour, it's like 1.5 hour, or maybe 1 hour, like 45 minutes or 55 minutes. That was only that much. Students, in that we have covered so beautifully, so beautifully, so elegantly, just like looking like a wow. That type we have covered like financial assets. Okay, so please do visit that, please do check that video, because if I just go on explaining you again, it will be just like double for those who have already seen that. Okay, so that is my financial asset. Then what about my financial liability? How many parts it's bifurcated? So yeah, my financial liability was bifurcated only in two parts, which is amortized and FETPR, because we don't have a concept of OCI in financial liability. Then we even understood, like if it's a transaction cost which is incurred, so over here in the financial asset we add it, in the financial liability we reduce it. Clear? So these are certain concepts we did. Then later on, students, I started with the credit risk also. Like if I am the bank and if I'm going to get some of the other things from another company, definitely, or my debtors, and if they fail to make me payments, this is a risk for the company. If this is a risk for the company, how should the company book? Like as in when the loss happens, at the time should I book? So it's bigger no, it's big no. See ma'am, you have to see, ma'am, we have to analyze, we have to estimate what can be the maximum possible losses. If I understand these are my maximum possible losses, at that much I can book considering the percentage. It is same like we are having now that what you can say, provisions for doubtful debt, provisions for bad debt, that way, students. Okay, so we have to consider all those stuff. So yeah, my hair's all curly, I know. Yeah. fine. So yeah, we just normally have, for example, let's say I feel like it's a Vijay Mallya type of person to whom I have sold the goods, and I am so sure that he'll never ever make me payments, never ever. So I have to book it, the losses today itself. I should not wait like for 5 years and then book a loss. No. It will eventually be wrong. So considering the percentage, considering the estimates, considering the assumptions, we have to book the losses perfectly. And that is known as impairment loss. So all the stuffs we have completed, even we have started and completed with a small portion of derivatives. So if it's a derivative, how will I account it for that? So if it's a derivative, means it's a short-term plan for you guys to invest. No, it's something like betting, where investments, if I'm putting it or not putting it, it's enough. Like a little investment may be required, but it is going to get profits or losses based on the net settlement. If it's a net settlement, and you get some gains and losses or whatever it is, whatever, that is something for you is to be booked directly into P&L account, because your merry intention at the time when you were starting with the derivatives was to earn profits or to incur no losses. Yeah, it could be both the ways, but eventually you end up maybe in losses and profits. That's upon how the market and things are as such, that which are something, yeah, we are beyond our control. So that is known as derivatives. So with the derivatives, we have just learned the definition of 4 parts, which is futures, which is forwards, swaps and option. Okay, today we'll be going ahead with a good concept which is known as hedging. Okay, so what is hedging for first? people have a lot of confusion, okay, in hedging, and people like feel this hedging is very difficult. Yeah, people feel like hedging is very difficult, but is it so? So I normally now explain my students the hedging meaning as such. Okay, I try to explain them in a very simple way. So what is hedging and who does hedging, students? Hedging is done by each and every individual. Like if it's you, if it's me, we all do hedging. So what's hedging? For example, yeah, I have already introduced, yeah, myself, Chartered Accountant Ashwini Bhanushali. Yeah, I always forget to introduce myself, but yeah, it's fine, it's fine. Yeah, we are more of concerned with the subject, for sure. Okay, when it's hedging means, as I am a Chartered Accountant, I initially had my work at my priority, like I was having my offices, for sure. Even that is something which I have it today. So that work was going on fine, fine, fine. It was good, and I was like occupied with my work. But then I realized that I am passionate something about else, about teaching. It's one of my favorite thing. So what I thought of, let my office be at its own place. Let it goes on working, working, working. We need to start something else also. So I thought of like, why not to be a tutor? So what I did, being a tutor, did I left my job? Did I left my work? No, I didn't left my profession. Why? Because what I felt, if my teaching didn't work well, maybe at least I'm having some backup plan. Yes, hedging is nothing other than the backup plan. The backup plan. Backup plan means over here we need to know, if I'm having hedging means we need to have some 2 contracts in hedging. From the exam perspective, we need to know it's basically the 2 contracts. Like one needs to be a hedged item, another needs to be a hedging instrument. Okay, if I talk to you about instrument, we know what is instrument. Ma'am, instrument is something like the derivatives. Yeah, derivatives means, ma'am, some instruments like purchasing some bonds, etc., etc., and some things like instrument. So over here, when I enter into 2 contracts, basically in hedging, there are 2 elements. First is a non-derivative element. Another one is a derivative element. So if it's a derivative element means, some or the other way, I will urge from my mindset, okay, I want profits, ma'am. Yeah, I want profits for sure. This is what I would have entered for profits. But not just profit, but even losses can occur, since to safeguard my hedged item. For example, just imagine, to safeguard this. So what's hedged item for the post? Okay, I'll give you one beautiful example. See, I want to set up a McDonald's in India. Okay, I want to set up a McD. So maybe I want to set up after 2 months. So what I'll require a lot of stuff. Like for example, I would want the infrastructure. Maybe I want some, the recipes and everything. I need to exactly prepare how the main company prepares it, like how the food industry prepares it, that way, so that I'll be having, like, say for example, franchisee or whatever it is. Okay, so what I have to do, for example, I want to like after 2 months, okay, after 2 months I want to set up a McD. Yeah, so for that, what happened, I want to purchase potatoes, because yeah, we know without potatoes, or like we'll not be able to make the french fries, we'll not be able to make the burgers, stickies and all everything. Yeah. So students, if I wanted to purchase potatoes, can I purchase it from market? Yeah, I can purchase it. But there was a thing, like whatever I want to import the materials, I have to import it from the country only. Okay, foreign country. It's okay. If you want to purchase it from foreign country, maybe from US for example. Oh, I know. Okay, if I want to purchase it from US, I need to purchase it when? Today if I purchase it, don't you think it will be rotten? Yeah, ma'am, it will be very bad. For 2 months afterwards you want to start. Maybe I want to purchase it after 2 months. So what should I do today? Okay, so I understood. Let's say, I don't know, maybe today, the prices of rupee per dollar for turns around to be, let's say, 90. And for 1 kg, I require, let's say, $1. Okay, for example, so I have to pay rupee 90 in India. That way, I have purchased, let's say, 500 kgs of potatoes at the rate of $1 per kg. So today, what I think, what should be my payment? So ma'am, it will be 50 into 90. Like you need to pay, for example, 45,000 rupees if you pay it today. if you pay it today. So this is what I thought. But today I am least concerned because I want to purchase after 2 months. So I'll be very much having a fear. So what eventually I can enter is, I can safeguard my thing here. I can safeguard my thing here by these potatoes. This potato is what? This potato is nothing other than my hedged item. Yes. Now this potato is known as my hedged item, because to safeguard the price of the potato, I am doing a hedging. So what I will do, this is my hedged item, means I will see whatever the price is. For example, let's say after 2 months, when I went to purchase the potato, let's say rupee per dollar turned around to be 98. Okay, so what I will do is, ma'am, 500 into 98. So I ended up actually paying how much? So like actually I paid rupees 49,000. Okay. So actually I paid this much. This is my normal contract. This is my normal regular contract. It's my normal regular contract. But I am having confusion, right? I am having doubt. Maybe the value will increase. So this is normal contract, ma'am. For this, nothing like hedging came into picture, ma'am. It is a normal contract. It's a normal contract. This much is a normal contract. To hedge that hedging item, to hedge the item, I enter into another contract which is known as hedging instrument. That is nothing other than the derivative contract. For example, today I entered into a forward contract to purchase, let's say 500 kgs of potatoes. So I'll go to the bank. I'll say, "Ke chalo baba, today rupee per dollar is standing at the rate of 90." What it was? Okay, today it was 90. Okay, today it was 90, and bank gave me a rate. Like whatever the rate is, I have to pay how much? The bank has promised me that I have to pay at the rate of rupee per dollar, let's say 94. So I was assured by how much? Now what's the surety? Like 94 into 500. So now I'm sure that I have to pay 47,000. So I'll be sure now I will pay at 47,000. So I have made a promise to purchase the instrument at purchase at the rate of 47,000. So will I pay 47,000 to bank? No, it's an item. So we have made a contract. Okay, I will buy at 47,000. Cool. Now what happened? Let's say this is going to settle when we have to make the settlements, right? Let's say the settlement is going to be made when settlement is made after 2 months. After 2 months, what's the actual price, ma'am? The actual price turned around to be rupee per dollar 98, right? Is it a gain for you or loss? Just imagine over here. 98. Yeah, 98. It's 98. It's a gain for you. Why? Arey Baba, you thought that you can purchase at the rate of 47,000, but eventually in the market the rate went off 98 into 500. It is 49,000. So you saved how much? You saved $2,000. Means you have won 2,000. You have earned 2,000. It's a earnings of 2,000. So it's basically known as a derivative financial asset account debit of 2,000, and like whatever I want to, like it's an asset, so maybe I have to consider it. It's an fayda, so I have to book where? It's where to be booked? Directly to profit and loss account. Yeah. Yes, students. Now this is something which is known as hedged item. Okay, hedged item and hedged instrument. Okay, so this is what I just wanted to explain you. But over here, when we have a concept of hedged item and instrument, we have two parts in hedging. So it's basically as per the fair value method, and there is like two methods, fair value, and over here if you can see it's a cash flow. Okay, but that's fine. We need to know the hedging method is what. So hedged accounting is a method of managing risk by designating one or more hedging instrument entering into derivative, so that if there is any change in the fair value at the year end, yeah, of the hedged item, it can be settled. Okay, so what's hedged item? Basically the hedged item, like I told you, potato for me. So hedged item is an asset and liability that exposes to the entity to risk the changes which can come in the future values. So there are three types of hedging. Okay, if you just normally understand what's hedged accounting, we need to have somewhere assets or liabilities. If there is any commitment which is pending, so we have to record that also on the specified date. It's highly probable, means future you have to anticipate. And if you read this is very important. A hedged instrument means a derivative is it's a designated derivative or non-derivative financial asset or liability whose fair value depends upon the changes in the market which can impact the hedged item. So over here there are types of hedging. First is the fair value hedge. In the fair value hedge, what happened? Just try to understand. This is basically a hedge which has an exposure to change in the fair value of the recognized asset and liability or unrecognized firm's commitment. So if you want to be very clear, I'll tell you in the fair value hedge where it is useful. For example, if I am entering into any hedging for the inventories, means which is on the day-to-day basis. If something is on the day-to-day basis, every change which is happening, for example, changes are happening, let's say I have entered into a transaction on 1st November 2022. My year ends on 31st/12/2022 and my settlement of that purpose gonna be, let's say, on 31st Jan 2023. Let's say I have entered into for 2 months hedging. Yeah, so what should I do? Ma'am, for these changes also I have to book, because at every reporting period I have to check through fair value. Yes, every reporting period I have to analyze fair value. Same way, at the rate of settlement also we have to check the fair value and measure whatever changes are there in your P&L account, because it is fair value hedge. Yes, yes. Then what is cash flow hedge? It's a hedge mostly recognized. We have to understand what is my value of the asset or liability. If there is any change, because in the fair value, in the market, if there is any change in the situation, how much should I book in my OCI and how much should I book in my P&L? To the extent of revaluation, you can book in the OCI, rather you have to book in your P&L statement only. See, from this, maybe you will be feeling very confusing up till unless we do with some questions. So yeah, I'm just closing it up, and we'll be doing it with some 2 beautiful questions that will be having some clarity more in the concept. So yeah, just let me open up the things for you. I'll be just putting up the question for you. Maybe you can analyze that part. I don't know whether it will be able for you to see or not. Okay, I'll just try to make it up. Just give me 1 minute, huh? Yeah, students, we need to be very slow in the concepts which I am trying to cover right now. Please be very slow. I've just opened it up. There's one concept of fair value hedge. Okay, I'll just open it up for once. Just 1 minute. Yeah, are you able to see this? Yeah, cool. Chalo, we can just start the concept of hedge. This also fair value hedge. So what's the meaning of fair value hedge? So I normally told you, if you are having any sort of inventories, mostly in the part of inventories, we can normally have this fair value hedge when the value changes on and on. Okay, so yeah, without any further delay, let's assume it and read the questions. So if you see, first of all, now always try to set up with the requirements. So what have they asked us? Okay, set out the accounting entries for the above transactions. Okay, the IFRS 9 hedging accounting criteria has been met. Okay, so what are we going to do, ma'am? We are going to do hedging. So hedging accounting criteria are met. So IFRS 9 hedging is the concept. Okay, so let's read it. Slowly we'll go. Definitely I'll not rush. On 1st July 2006, the company, the Jules, acquired 10,000 ounces of raw material, means 10,000 kgs, that way it's an ounce, it's a valuing of the quantity that way. Okay, 10,000 ounces of raw material which it is held as inventories. So on 1/1/2006 the company was having some inventory. Okay, it was acquired, it is having some inventory, it has purchased some inventories at the rate of 10,000 ounces, at the rate of how much, students? Yeah, 10,000. Yeah, 10,000 at the rate of how much, students? At the rate of dollar 200. It gives me up a total of 2 millions. Okay, on day one it is this scenario. Clear? Very clear. It's visible. Now what happens? Jules was concerned that the price of the inventory would fall. What is the meaning of this? Jules was concerned that the price of the inventory of these will fall. See, to be very clear, what is the meaning of this? If you can just correlate it, students, if I'm having any sort of inventories, okay, if I'm having any sort of inventories, what is my first fear? Like if I'm trading into it, my first fear is that if you have inventories, you have purchased it costly, and if you're not able to sell at that amount, or maybe if you are not able to recover at least your cost, that is, ma'am, very bad. So you should be in the ability to get the cost back. So you should be good with getting some earnings. Yes. So my intentions are what, guys? What are my intentions? Okay, I am worrying maybe the price in the future may fall, etc, etc. Things can happen. Okay, cool. That is my expectations. Now what happened? So on 1st July, on this date itself, what happened? First, okay, sorry, it's 1/7. Okay, it's 1/7. Okay, on 1st July, the company sold. Achha, you are having inventory on 1/7/26. I sold the inventory at what? I sold the inventory in the future market. What is future market? Yes, I entered into a hedging instrument. So I promised that I will sell it, means I will receive $210. I will receive $210. That is what I made a promise for. Consider it. And when will you get the delivery? So the settlement will be made on which date? So my god, the settlement will be made on 30 June 27. Cool. So after 1 year, you will show like whatever the prices are there in the future market, or whatever it is there, I will definitely get 210. For example, in the future market, let's say the prices turns around to be 200. Still I am able to sell at 210. It's a benefit for me. But what if, ma'am, in the market, if it rises from 210 to 230? That is a loss which I have to pay. Okay, that is the overview of the concept of futures. Okay, on 1st July 2026, the date, the conditions of the hedgings are met. So okay, with the first para, I am able to like what you can say, summarize this much points. Cool. What happened? If you can see the dates which was given in the question, for example, you have started on 1/7/2006. Yeah, the settlement will be made on which date? Ma'am, on year 1. So after 1 year, 30 June 2027. So do you think in between this, does year end comes? Yes, ma'am, year end comes on 31st December 2026. Yes. So maybe on that year also I have to book some or the other changes in fair value. So maybe it can be the situation. It's okay, we will do it easily. We'll try to do it very easily. Okay, yeah, simple. Yeah, we'll try to do it very easily. So after reading the first para, let us go to second para. So they have given us on 31st December 2026 means year end, the year end of the company's period, the fair value of the inventory, means fair value of inventory. Can you tell me what was my day one's inventory? Not futures inventory. Ma'am, my day one's inventory, which I have wrote it with red color, the value of the inventory in my books of accounts was $200. So you remember, this is my financial statements. For example, I have to show only financial statements. In the financial position, this is my inventory. I have purchased it at 200. At the year end, if it is more, do I record it at 220? Yes, it's a gain. It's a gain for me. But gain means, does the value increases? Yes, ma'am, the value increases. The value obviously has to increase. If the value increases, what entry can I pass? Inventory account debit. Can I increase more? Yes. To P&L account. Yes. This is the stuff for your, this is the stuff for what? For your financial position of inventory. But what about future markets? Ma'am, future also there is a situation. So I have promised, okay, I will sell at 210. Okay. Now what happened at the year end? Oh, you have to check the fair value. Correct? Yes. See, trying to go very slow. Yeah. While the future price, okay, on 31st December, I saw the future price. If I would have not entered on that 1st July, if I would have entered on 31st December, the future prices were 227. Means I was able to sell at 227. Shit. I would have sold the future prices 227. Oh no. Why oh no? Whatever the prices are in the market, I have already promised. This is my promise. This is my promise that I will sell at 210. But what if in the future on December I can sell it on 227? Means if you would have not contracted, yeah, you would have sold 227. Ma'am, it's a loss. Yes, it's a loss because you are now not able to sell at 227. You are obliged to sell at 227. So you have to sell at 210 only. So ma'am, there is a loss. Loss of how much? Ma'am, it's a loss because now your opportunity to get 17 went off. So this loss is nothing other than your derivative financial liability which you have to pay on the settlement. Clear? So this is a concept of future which we are coming ahead. See, I'm planning to explain you very easily. Yeah, so please try to understand. Okay, please try to understand. Cool. I know it's not so difficult. But what about inventory, guys? What about inventory? Ma'am, inventories, we are at gain. We are at a good position because day one I thought my inventory needs to be 220. 200. Now it's 220. It's gain, ma'am. It's gain. It's good thing. Good of 20. So 20 plus we are going. Cool. Now what's the up next thing they have already presented us in the question? Okay. So till here we read. Now on the actual date of settlement, on which date? On 30 June 20x7, the trader sold the inventory. They sold also. So inventory's position cancel, futures position cancel. You have to cancel both and close the future position at spot price of, means on that date we get the actual price, and actual price for both the stuff is gonna be same. There is $230 and $230. Oh my god. So if it's $230, I'll just change the color for sure. It's blue. Okay, with blue I will do it over here. Try to understand it. This is over here. Now what happened at the year end position? It's done. Now on the date of settlement, if your assets balance is 230, ma'am, it's a gain. Like day one it was 200, you added more 20, so now your balance is seen at 220. Please increase it. So you have extra gain of how much? Gain of further 10 for your inventory. But what for your futures, ma'am? Futures, I have promised a settlement. The value turns around to be, let's say, 230. So you thought you will be selling at 210. So you promised to sell at 210. Shit, ma'am. If I would have not promised, I would have able to get 230. But I made a promise to sell at 210. So from here to here, ma'am, there was 17's loss. So now your futures are seen at this price. Ma'am, there is further loss of 3. So if you compare directly this 210 and 230, there is still a loss of 20, which is 10 in this. So basically, students, in these I am having 17's loss and 3's loss. So I have a total loss of how much? Loss of 20. But in the normal position, guys, I am having a gain. Gain of how much? Gain of 20 and 10. So yes, at the end I am having a gain of 30 here. 30, okay, it's not a loss, so I'll not mark it this way. I'll not put this. So yeah. So students, just imagine, so simple it is if you are good in making this table. So yeah, over here I'm having a gain of 30 and over here I'm having a loss of 20. So if I net it off, is it not a net gain? Yeah, it's a net gain of 10 at least. So that is what? It's nothing other than hedging. It's nothing other than hedging. So you just want to cover your risk. That's all. Okay. Now, if you okay, the question is all set over. I'll just try to explain you once again. So what they have given up in the question is, see. Try to understand it very easily. For example, I'm having some of the other assets. Okay, inventory, which is day to day into trading. So whatever is the gains and losses, we can directly book in the P&L account and we can be relieved. Okay, so what happened? Day one the balance was something. If I saw, acha, your asset is increasing, your inventory is increasing, it's a gain. But what in the future market? I have promised to sell it less. Ma'am, it's a loss. Otherwise, if you would have not promised, you would have got more gains. Yes, ma'am. No, this is the thing. And they have asked us what? Please prepare the accounting entries for the above. Okay. Now, students, we'll go very slowly. For first, what is this, guys? It's a fair value hedge. It's what? It's the fair value hedge. And what are we going to do? In the books of accounts, I have to understand it. What is a day one situation? Okay. First, please go ahead with the inventory portion. What is the inventory, guys? On day one, what's the inventory? Acha, I'll just figure it out. Ma'am, day one inventory was 200 on 1/7/20x 6, and I was having 10,000 ounces. Can I write like this? On 1/7/2006, I am having 20,000 like 10,000 ounces, and I have purchased it at what value? Have I purchased it at 200? Yes. This is my books of accounts for my inventory. Yeah, cool. Cool. Hey, what happens, ma'am? There is a year end. Oh yeah, year end. What it is, ma'am? On year end, the balance of the inventory. Can you see this turned around to be 220, ma'am? It's a gain. Gain of how much? Yeah, is it a gain of this? Yeah, is it a gain of this? Can I divide it? Yes, ma'am. So if this is a gain, can you tell me what accounting entry can I pass? What accounting entry can I pass? Okay. Can I shift this? Yeah, it will be like very big. Yeah, just give me a minute. What I can do is I can now just give me 1 minute because I wanted to click. Okay, I can do like this. I can now put it down. Maybe like that way I can do it so that it is clearly visible. Okay, so yeah, I can pass the entry also on the day one. What is the entry, guys? Can I put like inventory account debit? I want to increase it into P&L account. Yes, very simple, very simple. Inventory account debit to P&L. Now, after doing that, ma'am, we need to understand on the date at the end also for inventories. What was the end? On 31st December, it is 230. Okay, so then there is a gain of 10 also. Again, so you have to compare what? On 31st December, what was the value? Ma'am, the value was 220. Now it is 230. Ma'am, there is a gain of 10 again. So yeah, can I copy this entry and put it again like 1 lakhs? Yeah, ma'am, obviously. So is it not simple for inventory? Yeah, very, very simple, right? So yeah, it's cool. Inventories are done. Inventories are pretty done. I don't think that there is any sort of doubts in the inventories for sure. Inventories are pretty cool. But now, ma'am, we have to go ahead with the derivatives also. Yes. Just with the inventories, it's not going to work. We have to go ahead with the derivatives also. So what's the derivatives thought on the day one? So on the day one, it is promised that you will sell at what value, students? Ma'am, it's promised to sell at 210. Yeah, you promised that it will be sold at 210. So you will get only 210. What if the value increased at 227? Ma'am, it's a loss of 17. Yeah, it's a loss of 17. Yeah, it's a loss of 17 per ounce. So yeah, it's a loss of 17. So what I can do is, can I book like this over here? Yeah, future prices I thought was 210. 210. So this much I was supposed to sell it, but if I would have not entered, ma'am, this is a loss which I'm incurring. Yes. So if it's a loss, where is this loss going to go? Whatever type of things are, we have to directly book into the P&L account only because it is a derivative. Because it's a derivative. What I'll do, guys? Loss account debit to financial derivative liability. I hope we are getting it. Yes. I'm trying to go slow, very slow. But now what happened? Over here, I was having over here the loss of 17. Sure. Now, if I compare both those stuff, I am still having a loss of 3. So yeah, I have to still compare it. So I have to write 227 and 230 over here. So 31st December 20x6, it needs to be 227, and on 30 June, it needs to be how much? Yeah, so can I write like this? Yeah, it's this on 31st December, and let's say on 30 June, the settlement date, it's 23, right? It's 23. Yeah. So ma'am, obviously there is a loss. Just give me a minute. Yeah, there is obviously a loss. Loss of how much? Again, if you do it again like this minus this, definitely you will be having a loss of 30. So what entry can I pass it? Can I copy this again? Yeah, loss account debit to financial liability. Obviously, it's gonna be the same. Yes, simple, cool. So true, so true. Now, what am I left with? Okay, now you have by now booked the liability and everything stuff is over. Yeah. So by now what I have did it, guys, please try to understand it. Till now I have booked my liability also. Till now I have booked my inventories value. So by the end of the period, that is on 30 June 20x7, my inventory is valued at 230 and my liability is total 2 lakhs, right? My liability is total 2 lakhs. So it's 230. Yeah, if you can see 230 into 1000 ounces. So it's like 23 lakhs. Cool. So I can write my inventory as 23 lakhs. Now if I want to make the sales, because they have told please settle it also. So for example, if I want to make a sales, what entry can I pass? If I'm making a sales, my inventory will go. So cash account debit to sales. Yeah, to inventories. Can I pass like this? Yeah. Cash account debit to inventory. It will go. It will go. But what about the liability settlement? I have to settle the liability also. Yes, ma'am. Settlement, na? So this much I have to pay in cash. Financial liability of 2 lakhs. I am supposed to settle it in cash. So I just settled it in cash. Clear? Very clear. Are you pretty cool with this? Yes. So this is what the maximum difficult question it can come. And I hope we are ready with those stuffs also. Yeah. Are we fine with what is fair value hedge? Yes. Can we move ahead? Can we move ahead? Yeah. Don't you want any sort of breaks, no? Do you want any breaks? No, na? No, no. Yeah, I was just telling you guys that you don't want a break, and from my end only the things went off. Okay, yeah, just give me a minute. Like, we'll be doing something else also. We'll be doing the good question, which comes up ahead with the concept of, yeah, that is nothing other than cash flow hedge, which at times becomes important, but which at times becomes very, 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 very critical. Very critical. If people don't understand the concepts, otherwise it is very easy. Otherwise it's very easy. I found these concepts more easier than the fair value hedge also, but some of the people might find difficult. Okay. So yeah, I think it's visible for you guys. Yeah. So now I have tried making it easier, but yeah, ऐसा ही है ये question. So it's a big question. Yeah. Okay. Yeah, we'll just start it. See, when it is cash flow hedge now, just understand cash flow means what, you know? You are not into the daily transactions. It's not like inventories. It's something like an asset. It's something like an asset, means which does not change eventually. And if there is any change, the concept remains the same. The concept remains the same, what we did it. But we need to know if there is any change, then what things I should do. Should I put the full change into the P&L account? Or can I book anything in your OCI? You remember a concept of IS? Yeah, we have IS 16 that says if there is any change in the value of the asset because of fair value, if there is a gain, we don't put directly in P&L account. We have a concept of OCI. Yes. So just give me a minute. Yeah, actually I was having a word from my student. Yeah, sorry. I just didn't took up the chat. Yeah, so I was having a message on the Telegram about the question. So yeah, yeah, cool. No worries, no worries. Chalo. Okay, now up next we can go ahead with the cash flow hedge. So I was telling you about the cash flow hedge. In IS 16 we know one concept, like if there is any changes, okay. For example, in the I'm going ahead with IS 16 also. That is known as the PPE. Yes, PPE, you should know. Okay. For example, my carrying amount in the asset turns around to be, let's say, 2 lakhs. And if I see the fair value in the market, if it is, let's say, 2 lakh 20, what I'll do, ma'am, extra 20, it's a gain. But where is gain going to go? Is it going to go in P&L account? So students, we know, no, not at all. Because it's not a sale. If it's not a sale, then we go and transfer it to other comprehensive income. Yes, this is a concept of what we are very much aware of. The concept which is known as like the revaluation thing, which initially we used to call it as revaluation, but now it is OCI. Cool. Okay. Yeah. Now this is clear. Yeah. With this concept, I just want to delete it because we have. Otherwise, what I can do is I can just insert it more down. Yeah. Cool. Chalo. We'll refer this thing, cash flow. So what they have given in the question, the company signs up a contract on 1st November. Yeah, I just have to keep the phones off. Yeah, the company signs up a contract on 1st November 2021 to purchase an asset. In the previous question, it was inventory. Now it is asset. And when I have signed up on 1st November 20x2 for euro 6 CR, like 60 and 000 and 000. Cool. Students, please consider where are we situated. So if I have planned to purchase at 60 euro, like 6 crore or like whatever, 60,000, like that way, I have to pay what, guys? I have to know where I have to book, means what is my functional currency. Yeah, students, you must be knowing as per the IS 21 what's the meaning of functional currency. Yeah, you should know. Okay, the meaning of functional currency means the currency in which, or the country in which, or the place in which, or the environment in which the like the entity is economically operating. Yeah, the entity is operated and what gets influenced, that becomes your functional currency. Right. So when I go ahead with the functional currency, I just need to know that what is my functional currency. What they have told us, the company reports, okay, the company reports in US. If I report, my company reports in US, so my functional currency will be dollar. So I have to book everything in the dollar face. Yeah, sure. Now what happened? And the company hedges these transactions by entering into forward contract to buy, oh my god, 6 crore euro. Okay, on 1st November 20x2. Okay, and the rate is what? $1 is equal to this much euro, 1.5 euro. So can I confirm like what will be the value on my day one? Just imagine. On the spot rates, yeah, if the question is presented to you, yeah, these are the stuffs which are given to you. I'll just put it for the question which is there in the question, which will be obviously given to you. This could be the spot rates, yeah, and these another way could be your forward rates, because there could be a situation that you have to enter into any other stuff which is known as a situation when it is a derivative contract and somewhere it is a non-derivative contract, that way. So okay, there are two stuffs given in the question. So on day one, if you can analyze it short way, I'm making it short. I think it will be visible to you guys. On the short way, students, my value will be 1.5. My value will be 1.5. Okay, if you want, I'll not put it in any colors. It was just for us to understand easily. But meanwhile, right now I'll feel no colors. Then I'll feel definitely all the colors. Cool. So right now on the current date, students, it's 1.5. So can you tell me, if I am going to purchase things at the rate of 60, that means that is basically 6 crore euro and 6 crore euro, and my rate is, for example, US dollar 1.5, what will be my today's dollar? Today, what will I record? What do you think? So maybe that is something which is known as forward contract maybe. So what happened? Yeah, please, can you please record one thing? Can you please record things? Like over here, what it is written? Oh my god, sorry. Please consider things, what I'm making it important, because it needs to be analyzed very. So beta reports in US and it hedges these transactions by doing what? By entering into a forward contract to buy at 1.5. So if you see this forward contract, you have to deliver when? For the delivery as on this date, okay, because you have purchased on 1st November 20x1 and you are going to settle it on 1st November 20x2, like after 1 year. Your today's price, let's say it's 1.5 euro. So can you tell me how much dollars will be your today's forward? What will be your today's forward value? Yes, yes, yes. Perfect. If you guys got the value, perfect. I'm very happy because we have to book things in dollars. So is it this divided it by 1.5? Yes. So this all other stuffs considered it in dollars. Yes. So it's 4 CR. It's 4 CR. So today I think like my asset value is 4 CR. Okay. Up next I have to see, okay, at the year end, okay, on that day, can you tell me what will your asset in the financial position be at? Okay, this is what, this is your balance sheet. This is your balance sheet, this is your financial position, this is your forwards, means this is your derivatives. Okay, okay. Now in the financial position, what will be my asset at value? Okay, if you do this, divide by 1.45, what was prevalent in the market, now this becomes your balance sheet. My assets ka value is this. Okay, so if you're preparing a financial statements for over here, for example, this is my financial position. On day 1, your asset will be seen at what value? Like 4137931. Cool, that is the situation. Now what happened? We have to measure it every year end. Yeah, every year end we have to measure it. Let's say this is my year end, 31st December 20x1, 31st December 20x1. Let's say this asset in your financial positions balance is now 1.2. Please measure it as per 1.2. What do you think? What should be eventually your value? So ma'am, my value needs to be this much in the terms of dollars. What do you think? Is it increased or decreased? Yes, it's increased. It is increased. By how much? If your assets balance increases by so much, what do you think? Where it will go? Where it will go? Where it will go? Can I put it into OCI? Something around, I think, can be put it into OCI. Like I'm having confusion, like where it should go. Where it should go. Maybe it can go in OCI. That way, it's increased. Yeah. But same way, you have to know, like, if you have entered to purchase at this much amount, if you have entered to purchase forwards at this much amount, and what if the rate changes to this 1.24? Is it not that way? Just divide by 1.24. So even that is increased, ma'am. That means you need to know your purchase price is fixed. So you are sure that you are going to purchase at this value only. If you're purchasing at this value, so what do you think? If the market turns around to be this much, is it your gain? So people will get confused here. Guys, don't get confused. Just imagine, I have promised to purchase at 4 lakhs or 4 CR and the value increases in the market. I will be happy that I have purchased at a cheaper price. Ma'am, it's a gain for me. Yes. But how much gain? How much gain? So ma'am, my gain is this much. Yes. Now you have to analyze. Is the revaluation more or is your gain more? Yeah. I think my gain is, ma'am, more. It's okay. Then it's okay. Then you can do what? It's, ma'am, this gain is what? Nothing other than, it's a derivative financial asset. So please put an entry, derivative financial asset account debit. 2, ma'am, you can put complete thing in your other comprehensive income because that is something which is a gain for you, right? Can I put like this? Financial asset account debit to OCI equity. Yes. Pakka clear? Till now I think it's clear. Till the year end, things are very clear. What about after year end? Ma'am, after year end, if I'm just putting it up down, if I'm inserting lines, just try to understand it, guys. This is something after year end. Okay, so everything over here got ended. Fine. Now what happened, Baba? Year end came into picture. At year end, today, if you can see, on 31st December, my assets are valued at this. Okay, my derivative is valued at this because I have booked another gain also in your OCI account. Very clear. Now what if at the year end? You have to remeasure it again. So year end it will be divided by 1. So this divide by 1. So are you getting it 6? Okay, because it's this value. And actually the rates will be same. So now where your asset was looking at 5 CR, now it is at 6 CR. Is it again not your gain of 1 CR? Ma'am, it's a gain of 1 CR. How much is the gain? What is the actual gain? Yeah. So I told you 1 CR, but how did you got that? Is it seriously 1 CR only? So no ma'am, it's not exactly 1 CR. It's not exactly 1 CR. Why? Why you cannot book it completely as 1 CR right now? Because you have to see. First of all, here it is fine ma'am if you're booking it 1 CR. For example, I'm cutting it and pasting it over here. For example, yeah, over here to get the value like 6 divided by 1. You put it over here, that's fine. So what will be your exactly gain? Okay ma'am, I can put this way, 1 CR. I can put again with the pink color, means I can make it as an OCR. But see, over here ma'am, I have to check now. Yeah, you have to check. So what's the value ma'am? Again over here also actually it's 1. If I divide it by 1, I'm getting this value. But means you have promised to purchase it 4. Now if it is 6, ma'am, it's a gain of 2 CR. But how much you have already booked a gain? Ma'am, I have already booked a gain of this much, 83, 87097. So okay, please book the difference gain. Okay, so how much I can book? This much I can book again. So what do you think now this time? This time your derivative financial asset is more. Yeah, please try to understand it. I will book it with a different color. Maybe that could be easily visible. Okay. Yeah. Your derivative financial gain is this much. Yes. Please try to understand. And your OCI means your asset is increased by this much. Now what to be done? Simple ma'am, simple. How much your asset has increased, please that much thing you book it in your OCI. So only maximum this much is to be booked in OCI and remaining gain is to be booked in P&L account. I hope you guys are getting it. Yes. Can I write like this? Yes. Clear? Can I book this way? Are you agreeing these concepts? Yeah. Can I book like this? My financial account is a debit by how much? 116. Yeah, 116. And I can book the OCI that much amount. Agreed? OCI can I book this much and the remaining portion can I book in my P&L account? Are you agreeing this? Yes? If yes, yes students. Now this is what they have made the concepts of. This is how I have to go ahead. I hope even this is fine for us. Yeah, we can just manage it. Yeah, with these students, if I can conclude, yes, if I can conclude, we have covered like legitly not even two hours also. It would have not taken like 2.5 hours maximum. And yes, we are done with the very important financial instruments, and I hope you guys would have understood it to the extent and to the max. Yeah, so yes, this is what I was planning up to do it yesterday itself, but nevertheless we can go ahead with some few concepts also, that is known as ratio analysis. So I know ratio analysis is one of the favorite topics which every student have, because no matter you take up APM, no matter you take up any other subject, ratio analysis is something which is very common, like it comes every time, like in either of the subjects. So I was just wondering that if it's so common, why not to take that? Let's just quickly wind up the ratios also. So yeah, just we'll start it within 2 minutes. So yeah, if you want, you just can drink water, you just can have some food, like just a snack. Yeah. So students, if I ask you about ratio analysis, yeah, if I talk to you about ratio analysis, why do I want to understand ratio analysis? Is it something important for me to understand ratio analysis, or like it's just for like time pass chapter? So yeah, we know ma'am, ratios are very important. Like when we were in the schoolings also, we used to have certain ratios. So is it fine if I just give them the percentage? Okay baba, this is the percentage of the ratio and that's all. Is it enough? So very big no. It's a very big no. Why? Because if it was just a percentage which I was to give, then in the financial reporting's FR also I was having. Then why are they giving so easy things for us in the examination? With a good weightage, with a good marks? Just because when I am at a position of being a professional level, yeah, they would expect me to give a lot of analysis behind it. Yeah, they would want us to have a lot of knowledge, a lot of technical terms, like okay, if you are having some good GP ratio, so why it is, if you're having a huge turnover, why is it, if you're having a receivables amount more, like the days of receivables more, so why it is it good for the company or is it bad? So if it is good, what can be made to make it more good? And if it's bad, what can be the consequences that if I do it, like maybe because if it's bad, what are the consequences and what are the efforts which the company can put up so that eventually that bad thing also turns around to be at a good position. Yeah. So yes, students, with that overview, we can just have a glance of what is basically IFRS. Like it's not a particular IFRS, basically it's a ratio analysis, which terms around to be one of the favorite topic. I'm telling you, presently I know people will love this ratio analysis. Yeah, so people just love this topic. So I thought of if it's a love for everyone, yeah, we can just take it for sure, and that too very fast. Okay, so it will not take more time. Just give me a minute, students. I'm just opening it up the things. Yeah, this is personally one of my favorite topics. Okay. I think the PPT is also visible for yes. Yeah, so it's whenever you check the name now, it's not just ratio analysis. People will say it's a ratio analysis. So you know the meaning, there is a difference of the word analysis. So if it's a normal ratio, we can just find out the ratio. It's over. But when I go ahead with the meaning of analysis, we need to analyze many things behind that. Means the reasons I need to know. Okay, if this is a ratio which has come up, what can be the consequences and why it has come up like that way. So yeah, without any further delay, let's start with the ratio analysis. Just after a minute, like I'll drink water for sure. Yeah, just give me a minute. Yeah, so students, now let's understand the meaning of ratio analysis and interpretation. So yes, students, when I talk to you about the importance of ratio analysis in your upcoming paper, it is important not just from the financial terms. Okay, we will just find it. Yeah, it's very simple to find it. Okay, if it's very easy, if the previous year's net profits are lesser than the current year's net profits, okay, my current year's net profit is good. Okay, figures, anybody can find it out. We are at a position where we have to analyze the situation. We have to analyze like why are there any differences and what is the interpretation. How can I interpret? For example, if my ratios are getting down, for example, in the previous year my ratio was 20%, which in the current year has turned around to be 15%. It's why? What can be done for that, for increasing the ratios? How can I make it more better? Yeah. So all those stuffs are to be understood over here in the ratio analysis and interpretation. So I know this is one of the favorite standard for all the people, for all the students, and I expect if this question comes, it is the cash marks for us. So please see, in SBR, people make a mistake, which I'll definitely say. People will concentrate on the very difficult standard, expecting, ma'am, CFS is going to come, ma'am, IFRS 9 is going to come, ma'am, this is very hard. And it's okay. Things are difficult, but the difficulty level is only 20%. These all are the very easy topics which we just cannot leave it. Okay, so I just wanted us to have a glance over here. So yeah, without any delay, we need to understand about ratio analysis and interpretation. Yes. So if you check on this ratio analysis and interpretation, we have taken up a very beautiful pictogram over here which says interpretation and analysis is required. It can be in the percentage terms, in the financial terms, and non-financial terms also. The best example of non-financial term turns around to be the feedback which is being given by the customer, or the quality which I cannot measure it in the terms of quantify. I cannot do quantify, but I can obviously do the quality things. So I can just qualify the things. Like it's something which I can qualify. I can just write it. And last but not the least, it's integrated report. Means like in prior to many years, I used to make this report 1, report 2, report 3, report 4, report 5. Okay, this is my financial statements. This is my report for my external people. Achha, this is my report that I have contributed towards the CSR. This is another report, another report. Students, people don't have so much of time to go on check on this report, that report, this report. No. What we need to do? Take a report. Yeah, we can make like this. Take one report. Yeah, this is very bad, but yeah. Take one report. Yeah, this is a report. This is annexed. Yeah, if I want, please annex to this stuff. So different reports will make the things look very cumbersome. So it's something which I need to integrate things, and that's known as integrated reports. Yes. So yeah, without any further delay, let's start understanding what are the things. So yeah, ratio analysis is basically the financial analysis techniques which helps us in doing what? It's not just in calculation, but yeah, obviously interpretation of some ratios also. And these ratios are taken care perspectively how? The company's perspective considering these 4 parts. That is LPSE. What's that LPSE? That's liquidity, profitability, solvency and efficiency. Liquidity, profitability, solvency and efficiency. We'll go ahead very slowly with thanks, because I don't want, if this question comes into exams, I don't want your marks to be any which ways deducted. I want you to gain full marks in this concept. Cool? Yeah. So up next, over here, it's understood that what is this? What are these ratios going to help us or not? Yeah. So these are basically going to help to whom, guys? To the stakeholders. So you know who all are, guys, the stakeholders of the company? Yeah. So if anybody told that stakeholders are shareholders, I'll feel like no, your preparations are like a bit lesser, because stakeholders is a set of what? It's a set of everyone, whoever is interested in the company. No matter it is a shareholder, yeah, it's the customers, yeah, it's the employees of the company, yeah, it's the government, yeah, it's the management, it's it's the society, everyone who is interested in all another ways. It can be the financial help, it can be taken care of any decisions. So yes, if all these stuffs are there, definitely it's going to work well. Okay, cool. Up next, what are the things? Yeah, what is first? The liquidity ratio. What's liquidity ratio? I will not read it over here, all the stuffs. Okay, yeah, we can first start with the liquidity ratio. So if I ask you, liquidity means, for example, I want to purchase something, but I said, okay, I don't have cash, I don't have enough of cash, I don't have enough of liquid things to settle my obligation. So when a company wants to run in a smooth phase, yeah, in a smooth and streamlined manner, the important stuff is that they need to have a proper liquidity thing. Yeah, they need to have a proper liquidity thing. Liquidity means it should go easy. Yeah, things needs to be at a smooth line. So yeah, this is known as my liquidity ratio. Cool. So yeah, liquidity means you should have a current assets. Yeah, your current assets. Your current assets means your short-term assets. Your current assets should be enough to settle your liabilities, to settle your current liabilities. That means it measures the company's ability to meet the short-term obligations. For example, if I'm having, let's say, my current liability is to pay $5 lakhs, and I am having, let's say, current assets of 3 lakhs. Ma'am, it's not good. So what about 2 lakhs? Ma'am, you are having a less of capacity. It's not good. It's not good. It's not good. It's legitimately not good. So ma'am, this cannot be the situation. This cannot be the ideal situation of the company. Yeah. Yeah, this just cannot be the ideal situation of the company. The company should not have like these things, which is very less. Yeah. The company ideally should not have all those stuff. The company should have a proper position to settle its liability and equity. So when I say what is the ideal ratio, what's the ideal ratio? It needs to be current assets divided by current liabilities. We know this is the formula. I know everybody knows. So it needs to be 2:1. Means let's say my current liabilities are $1 lakh. So at least I should have $2 lakhs as my current assets. Why? even if I settle off my liability, I should be spared with some assets, right? So this is a situation. But what if I say, guys, your current liability is 1 lakh, and let's say you guys have an asset worth of 15 lakhs. Oh my god, ma'am, so much. It's good. No, it's not good. Why? What are my current assets consisting of? For example, just understand, whether am I having so much of cash? Cash? No, ma'am, it's cash. It can be current assets, can be cash, can be stock. For example, if I tell you 14 lakhs is my stock only, oh my god, so you'll not feel, okay, ma'am, that obviously means that your stock is not a fast moving good. Your stock is actually stocked only. Means maybe the demand is not there. Maybe all things can be analyzed. For example, I think your stock is maybe overvalued, or maybe your demand in the market is not so much, or maybe your stock will be kept will be obsolete. So ma'am, please take care of the stock. Yeah, this could be the current assets, and we need to figure it out what can be done for the current asset if it is so much exceeding, or if the stock is only, let's say, less. No, it's not so much also. Let's say, what if I tell you my cash is $1 lakh dollars. Yeah, my stock is, let's say, $2 lakh. Cool. My remaining, let's say, 12 lakhs. Yeah, 12 lakhs dollar is my debtors. So you'll be having a super wonderable thing that, ma'am, if I am having so much of debtors, whether the party are going to pay me or not. Is it not a situation that the debtors will not pay me and the things will be doubtful? Yeah, means that can be a concern for the company. Okay, that can be a concern for the company. So please, we have to analyze that stuff too. Okay, so that is known as the liquidity ratio. So yeah, I have just tried to explain you a simple concept. Yeah, we'll have a lot of things to be done in the upcoming part, where we have some formulas and all things. Okay, so now what is first liquidity? Second is profitability. So what's profitability? When I talk to you about profitability, it is something based on profitability. Means profit. Hey, before I go ahead with any ratios, what is the base? Why am I finding out the ratios? Yeah, I wanted to explain you prior only. Yeah, please try to understand it. Yeah. Yeah, students, we just need to know, like, why am I preparing this ratios and all, right? Yeah, like, what is the need of preparing ratios? So for that, let's understand. Yeah, the concept is very easy, right, ma'am? It's the ratio, analysis and interpretation. Yeah, when it is very simple, yeah, ratio, analysis and interpretation. But what is the base? Like, why am I supposed to do so? So ma'am, it's just like simple, ma'am. For example, if I say you, okay ma'am, the current year and the previous year. Okay, the previous year, let's say I'm talking about the profits. Let's say the previous year's profit was $5 lakhs. Okay, dollars. And if I say in the current year, the profits are 7 lakhs. So if I just take these numbers, I feel, yeah, current year situation is very better, ma'am. What I did it right now, ma'am, I just did it first. The comparison. I did the comparison, right? But can I compare it and can I conclude it? No, ma'am, current year's is best. If I just relied on it, the current year's profit is best. I can be wrong. Why I can be wrong? There can be a situation where you have to find out. Okay, if it's profit, can you please tell me what is the sales? I told, okay, Baba, the sales in the previous year was, let's say, 10 lakhs. Okay. And in the current year, let's say my sales was 50 lakhs. Oh, if it's so, means by making a sale of 10 lakhs, if I can earn 5 lakhs, okay, by making a sale of, just I'm putting it with the different color, so it will look more beautiful. By making a sale of 10 lakhs, if I earn a profit of 5 lakhs, it's good. Like, if I can take up the ratio. So what's a ratio? What's a percentage? So if I make a net profit percentage or net profit sales, it turns around to be 5 lakhs. That is basically profit divided by sales. 5 lakhs divided by 10 lakhs into 100. So am I not getting something around like 50%? Yes. So if it's 10 lakhs and you are able to make a 50% sale of, or like profit of 5 lakhs, it's good. Like over here it is 50%. But what about this percent? Yeah, 7 lakhs divided by 50 lakhs. Guys, please do it. It's only 14%. So just with the financial terms, just with the financial numbers now, things will not be proper. We have to get things into the percentage. That is known as, it needs to be comparable in such a perfect way. So I told you, there is a saying by the Peter Drucker, or he told me, that something which can be measured gets done correct. Means if I can measure things, over here, if I can measure here things with a percentage, we can do it more better. So yes, students. And how can I interpret? What can be the reasons of, oh my god, having so much of sales but only getting this much of profit? Reasons. How can I improve? So all these things we are going to learn in the ratio analysis and interpretation. Yes, I hope you're getting it, the core concepts. Okay. So if I want to just compare it, can I compare it with the current year and the previous year only? No, ma'am. We can compare it intra, that is inside the company. We can even compare. Say for example, this is my business, which is let's say like current year. I'm into the business of, let's say, telecom industry. This is basically Jio. I can compare Jio with Airtel of the similar industry. Means I can do intra comparison and I can do inter comparison also. Intra means inside the company inside. Maybe I can do intra comparison with similar things. Okay, so this is just the normal concept of ratio analysis and interpretation. Up next, I was explaining you about these margins, these ratios. So here ratios means percentage, something in percentage we have to calculate it. So it's GP margin, very easy. GP, who never knows, ma'am? Everybody knows, ma'am, GP. Yeah, who never knows GP? Yeah. For example, just try to understand it. Okay. This is my company A. I'm having sales value. Sales minus the variable cost. We get what, guys? We get contribution. Yeah. Variable cost, or like it can be direct material, it can be direct labor, it can be direct expenses, or whatever it is. Or I can say COGS, cost of goods sold. If I'm deducting all the cost of goods sold, opening stock plus purchase minus, I get contribution, or it is known as GP, gross profit. So what I do, if I compare this GP and this sales, I get the GP ratio. Out of that, if I deduct the fixed cost and all the stuff, other overheads, I get what, guys? I get net profit. If I compare this net profit along with the sales, I get the NP ratio also. Is it not very simple? Yeah, ma'am, it's very simple. So GP means it measures the profitability of the company's core operations. Core, what it is entering into the main, like the direct things. Higher the margin means more the profitability the company is. What is an NP ratio? Yeah, what is NP ratio? What is net profit margin? Measuring the profitability after considering all means all, huh? All the expenses. It's fixed cost, it's like other overheads. A higher the margin means better the company is having the work efficiency. Then, yes, students, now this becomes the most important thing in the like profitability ratio, return on equity. That means what amount of profit you are getting it, the profits, amount of profit. If you invest so much things as the equity fund, like it can be the shareholders equity and all. So if I invest, let's say 1 lakh, and if I can invest on my capital employed, or my equity, let's say is 1 lakh, and if I can earn 10,000, it's like 10% of that. But what if I say I invested 20 lakhs and I earned 10%, or I earned only 10,000? Ma'am, it's only 5%. So that shows the higher the ROE, the better the utilization of the funds is. And yes, students, this becomes important because ROE is what normally the company understands it, considering, okay, Baba, this is what we want to go ahead with. So they won't want to compare the companies with the perspective of ROE. Okay, so yeah, this is what we can go ahead with. So by now we have completed 2 points. I have not even started with the formula. Okay, it's just like I'm going with the background. Yeah. So what are the 2 things that we did it, students? So yeah, we were able to manage to understand the concepts related to what? Yeah, to the liquidity funds, like liquidity ratios, then profitability ratios. The most important coverage comes here is of solvency ratios. So when I talk to you about solvency ratios, it says debt to equity. Means I want to know whenever, for example, if I am thinking of investment somewhere, yeah, as an individual also. So I'll think, ma'am, if I want more returns now, invest in equity. Yeah. If I want a favorable returns, please invest in debts like in debentures. So what's that? Because equities gives a comparative higher returns. It's higher risky also. So yeah, that is known as debt to equity. Means I need to know in my company, this is my company's finances are how much, like are my finances completely of debts, or are my finances completely of equity or not? If it's the combination of both, like what is the percentage, what's the situation? So lower the ratio, it's better. Why? If your equity or things, if it's lower, means your risks are less. If it's lower, more the better it is. Yeah, we'll be doing with the questions for sure. Okay, up next over here, the interest coverage ratio. Now what's the interest coverage ratio? Okay, we need to measure the company is having any ability to utilize, to cover the interest expenses with its earning only. So I need to know how much debt it is funded. If it is debt funded, definitely for debt funded I have to pay them interest. Like interest is to be paid. So I have to know, achha, if more the profit I'll be having, definitely I'll be having a good capacity to pay the debenture holders. Yeah. So the higher the ratio, more it shows the better efficiency and the solvency of the company. Yes. Over here, it's the efficiency ratio, which is very easy. Like inventory turnover, is it's receivable turnover, payable. So what's that? Inventory turnover. I need to know if I'm having, let's say, X amount of inventory, how frequent and how easily the company is able to sell the equity. Means this is very difficult to sell the equity. Why? It's very difficult to sell the inventory. Why? Maybe because there is no demand. Maybe whatever inventory I'm selling it's very much damaged. So what people do? People will return the things. So why am I having so much of stuff of inventory? So we can get to know like how efficiently I can sell my inventory. So it shows currently, like quickly, the measures how quickly the company sells its inventory. Higher the ratio, more the better the company is. Okay. Then we have accounts receivable. Turnover means, for example, if I'm making sales, I'm having a lot of debtors. I need to know within how many period will they make me the payment. Okay, I get to know that my debtors now take very long to make me payments. I thought like they'll make a payment within a period of, let's say, 30 days. But then I get to know, counting the turnover, I got to know, no, they are making the payment in 45 days. Is it good? Higher, is it good? Higher days, is it good? No, higher days are not good. But we have some ratio to be done. Why higher days are not good? Arey Papa, that much time you will not be having cash. Like more 15 days. So higher the ratio, better the receivable management is. Because it measures how quickly I am able to collect my receivables. How quickly I'm able to collect the receivables. Now that's important. Because if I am good in collection of the receivables, that shows that I can easily get the flow cash, the cash flow in my company. Similarly, over here, they have given up some formulas by now. So yeah, we can first go ahead with the GP margin. So what's gross profit? Yeah, we know. We have sales, we have some gross profits. Yeah. So what I can do? I can do GP upon revenue into 100. Is my gross profit margin. If I feel in the current year, ma'am, my GP ratio is good, very good, very beautiful. Why? Why will my GP ratio be more? Maybe, ma'am, if I can do more sales, yeah, my profit will be more. Or, ma'am, if I have less cost or expenses, my GP will be more. How can I increase my sales? Maybe, ma'am, my selling price could be more. Yeah. Maybe you are selling a good quality products, so the people are liking more. Yeah, it can be both the ways. How can your cost of production be reduced? Because GP is calculated like that, over here in a normal situation, revenue minus ma'am cost of goods sold without any other cost. Yeah, so it's basically direct cost, right? If it's a direct cost, okay, how can my cost be reduced, ma'am? I don't have other things, but at least can I have one proper supplier from whom I can purchase? Yeah, if I don't have, let's say, 10 suppliers, if I just purchase from one supplier, he'll be very much faithful to me. Even he'll give me a good quality products. Along with that, he'll give me a good amount of discount also. Yes. If I purchase in the bulk, I'll get some discounts also. And maybe if I was preparing, let's say, material, I was preparing some thing with material A and B, and I got to know B is very costly, but I can get its better substitute, same but at a reduced price. Yeah, I can change my sales mix and something like that. Okay, but yeah, please don't compromise with the quality. Yeah, please don't compromise. Otherwise, what will happen in the long run? Now, the company will have to suffer a lot. The company will have to definitely suffer a lot, and that is something which the company cannot afford. Yeah, that is something which the company cannot afford. So that is nothing other than the GP margin. So gross profit margin is very simple. GP upon sales into 100. GP upon revenue into 100. Clear? Up next, students, we have operating profit. So what's operating profit? Operating profit is similar to like net profit. Like operating profit upon revenue into 100. That means operating profit is affected by many factors. Why? Why will I affect? You know, there is a concept which is known as depreciation and all. So ma'am, we take up all the expenditure, right? All means all, yeah. If I take up all the expenditure, don't you think every time the depreciation, whatever I thought and whatever actually came, could be different? Yeah ma'am, it can be. Like it is nothing which is like it cannot be different. It can be different. It can be different for sure. If it can be different, then can there be any changes? Yeah, there can be any changes. My estimation in the previous year was different, in the current year was different. Because of that, can it affect? Yes, it can affect the profits. So there are a lot of stuffs over here in the operating profit. So yeah, a lot of things can manipulate my profits also, can manipulate my ratios also. So operating profit margin is affected by more factors than the GP margin, because many operating costs are fixed, like for example rentals and all are fixed, and therefore it will not increase or decrease anything. Means like it will not affect so much. For sure it will not affect so much. This means that the operating profit margin may be more volatile. Yeah, not necessarily. Yeah, because what will affect more is over here heavy reliance on what, such as depreciation, impairment loss. Yes ma'am, that impairment loss. If your assets value, I thought my current asset, my carrying amount of the asset was, let's say, 1 lakh, and in the market, if you see, your fair value turns around to be only 20k. Oh my god ma'am, what about 80? Yeah, it's a loss. Which loss? Impairment loss. Where is it going to come? Into P&L account. Simple. It's a loss, because of which again what will happen? Oh, your profit will be reduced. Your ratios will be affected. Yeah, so this may have the ability to hinder the ability to compare the operating profit of one company even with another, or maybe with the current year or previous year also. So yes, there are things. Yeah, there are things which can affect. So the first thing we understood very well, it's about gross profit margin. We understood about the operating profit margin also. Yeah, now up next we have the most important topic, which is not a ROCE. Yes, what is ROCE? What is return on capital employed? So when I talk to you about capital employed, what is capital employed? It's something like equity portion and some interest bearing finance. So if I say interest bearing finance, means what's interest cost? No. Debenture holders. It's equity plus interest bearing finance, like the debentures and all, to whom I have to pay the interest. So I have to see how much profit is available for me to pay to my equity holders plus my debenture holders. What's the percentage of profit? So what entry can I pass is, what can be my formula over here is, okay, yeah, it eventually happens that way with me. It's okay. So here what is given? Operating profit divided by capital employed into 100. So what is my operating profit which is left over? Divide by the capital employed. Capital employed means equity plus debentures. So we need to see whenever I see in the paper now, they'll give you like this also, that the company is having the estimated ROEC. The company was having previous year let's say the ROCE, the return on capital employed of let's say 14%. Please calculate what is the current year's better. So what I can do, it's useful for understanding and comparing with the previous year's figure, or they will give you, acha, this is the company's current year's target. Current year's target is let's say 20%. Are you satisfying it? So yeah, maybe that. Maybe I can compare it with the comparatives, and maybe that could be a cost of borrowing also. Easy, simple, simple, simple. I think it's very pretty easy. Like nothing difficult in the standard for sure. This chapter is very easy. Up next, we have the most easiest point which is left over are basically liquidity and working capital. So what's liquidity and working capital? Yeah, liquidity means something I want to like pay it fast. It needs to be liquid assets. It needs to be liquid liabilities. Means it need not be a situation where I have to like store it for a long time. No, ma'am, we need to pay it. We need to pay it. So that terms around to be liquid, current assets and current liabilities. So when I talk to you about current ratios, my students, current ratios, it is clear current assets upon current liabilities. Okay, and the ideal ratio I told it needs to be 2:1 for sure. So current ratio means over here when the entity has sufficient current assets to meet the obligations. The higher the ratio, more the financially secure the company is. Okay, now very easy, ma'am. So what's inventory turnover? Yeah, inventory turnover. So what's that, guys? Inventory turnover means how long your inventory is going to be there in your company. Yeah. For example, what is my inventory? What is my inventory? Divide by cost of goods sold into 365 days. Yeah. So I can create the days in which my inventory is getting turnover. It's going ahead, front and to and fro. So over here, the higher inventory turnover. For example, over here, or let's say my inventory is more. My inventory is more in the stock. Oh my god, it's not even getting sold. Means it's bad. If you're getting a higher turnover, that means maybe your demand in the market of the inventory is not there. Maybe you don't have a proper inventory control, so that whatever the inventories are there in your company are basically as such which is not able to be sold because they are like deteriorated and whatever it is. Like it's just like that way. So that is known as inventory turnover. Up next, same thing, we have an receivable collection period. So what's receivable collection period? Yeah, so I need to know in the receivable collection period, if my trade receivables are more, yeah, divide by credit sales. An increase in the receivable collection period may suggest a lack of credit control, which could means if you have more receivables, means more people are not paying you money. That means there is a higher chance that maybe the people who are there can be the bad debts for the company. Maybe you just cannot like recover from the people if you have given them on credit sales. So more the receivable, it's not good for the company. The period, okay, the more the receivable, it's not good for the company. Similarly, when I talk to you about the payable payments, it is like ulta. It's ulta. Why ulta? Trade payables means to whom I need to pay, to whom I pay, because what I did it, I have purchased it. But how did I pay it cash? No, ma'am, I purchased it with the credit pay, and at 365 for that getting the days. For example, I wanted to pay that party within 30 days, but what if I get normal ratio that I normally pay it at 45 days? That means it's good for me. Why good for me? Means I am getting extra time, but it's bad for me also. Maybe the front party, the counterparty will think that I am actually not good. My financial position is not good to make the payment within a stipulated time period. So yes, it can be both the ways, right? It can be both the ways. So yeah, we need to take care of that also very well. Yeah. So it represents the credit period taken by the company from its suppliers. A long credit period can be good side because I get free sources of finance like my credit card bills. I get a long amount. However, if the entity is taking too long, suppliers will think, acha, this person is not having money, forget about him, from next time we will not pay him sales because he is not paying on time. Yeah, so it can be both the ways. Yes, students, now if you see this word gearing, it is something which is going to come up in the paper if the concepts comes from the like ratios. It can never be without gearing, okay? It has to be with gearing. Gearing means we need to know is the company having a risk of the debts to pay? Means should I pay the debts more? So I have to compare debt divided by equity plus debt, or in some portion it is written debt divided by equity. Means I need to know gearing the risk attached towards the finance. Means do the company has such a position that their debts are more or what? If the debts are more, that means more the interest you have to compulsorily pay. Because equity is more means what? Yeah, obviously the risk is more in equity, but it's not compulsory for them to pay the dividends and all. Yeah. So high geared entity, if you're not able to pay the situation, the higher the risk of insolvency turns around. So highly geared entity has a highly geared risk of insolvency. Yeah. What was interest cover? I told you, if the company is having some profits, right? If the company is having some X amount of profits, and out of this profits, how much they have to pay to those from whom they have taken up the debts. So to the finance cost. So interest cover over here, the indicates that what is the ability of the entity to pay interest out of the normal profits. Yeah, to pay the interest out of the normal profits generated. If a low cover hai, that means it is having a financial difficulty to pay the debts. It should have a proper amount of at least profits so that they can at least pay to the finance debts. Yeah, clear? Okay. Now we have some investors ratio which is known as PE ratio. Yeah, now this is something which is very easy, but again very simple. What's price earning ratio? I have, let's say, current share price, means something like market price. If I see divide by that, what's the earnings per share? I get the PE ratio, means how the double time, triple time, four times the per share earning is there, and what can be the market price. Okay, so over here we have a very important, the higher the PE ratio, the more the better it is. And we have an EPS in the next session, which is over here, which we have the concept which is known as IS 33, that is EPS. So what is the basic meaning of EPS? How are we going to go ahead with EPS? So yeah, that is something which we can understand it. Maybe we can take a break of 5 minutes, and yeah, we can resume it again. Yeah. Yes, students. So yeah, welcome back with IS 33 that talks about earnings per share. Yeah, students, this is gonna be the most important. Yes, students. So International Accounting Standard 33, amongst all those ratio interpretation, हमारे लिए like it can be important, but I can say you the most important over here the topic comes up along with us is first of all it turns around to be interest coverage, and yeah obviously the gearing ratio. Yeah. And even if I can say you the most important topic comes over here for us turns around to be ROCCE. Yeah. Okay. So students, now we are going to understand the EPS. So what is the meaning of EPS? So yeah, what's the meaning of EPS? Earnings per share. Is it very simple thing? Yeah, ma'am. It's very simple. It's just that we need to calculate the per share earnings of a company. If it's of a company, is it so easy to find EPS? So yeah, I'll explain you what is the meaning of EPS. I know student knows this concepts, yeah. But yeah, for us to understand in a better way, earnings per share means what is the profit available to each and every equity shareholder. So that is the concept of EPS. Means we need to know how much earnings I have to give or it's available so that the equity shareholder can be happy. So when it turns around to be EPS, there is a concept that we have to find out the EPS in two parts. Yeah. That is known as basic EPS, and another EPS is known as basically the diluted EPS. If I explain you the difference, we all know the basic EPS. So some of the students might not be knowing the meaning of diluted EPS, but nevertheless, will definitely understand the concepts. So is EPS very important for all the companies to be accounted for? So if you remember one standard which we have in our notes, basically that is IFRS for SMEs. Yeah, do you remember IFRS for SMEs? Yes. When it is IFRS for SMEs, do they have to report as per IS 33? They don't have to report as per IS 33. Because for SMEs, students we know, for small and medium enterprise, they themselves are very small. So they will not be having so much of like shareholders and all those stuffs. So it's okay if they don't report this. But where is this EPS going to be visible? Okay. So if I'm talking to you about EPS, students, it is being seen in the profit and loss statement down to whatever the total profits you get it. Down to that, if I want to have some additional information, so I am going to bifurcate it between basic EPS and dilutive EPS. Okay. So it's known as basic EPS and dilutive EPS. So okay, we'll be understanding these concepts with certain questions. Yeah, so I have not like taken up from the notes, but we have the questions. So yeah, without any further delay, I'll be explaining you with the questions, and yeah, we'll be understanding the concepts too. Cool. So yeah, without any further delay, so let us begin with the concept which is known as earnings per share. So when I talk to you about earnings per share, some or the other word we can relate is something like share, right? Something like shares. So what are shares for the first? Yeah, the company has issued some or the other things so that the people who are interested can take up. So is this shares, like which type of shares, ma'am? So if it's an EPS, what type of shares? Is it like preference share? Is it like equity shares? So yeah, whenever we have to calculate the per share, the share will be known as the ordinary shares. Ordinary shares. And ordinary shares are nothing other than the equity shares. Or I can say the potential shares which have a potentiality to convert it into equity. So yeah, they are known as the equity shares. So EPS means it's a measure, okay, it's a measure of the amounts of the profit which the company has earned in such a way that we can understand the earnings which are relevant towards cutting it, so that I can denote it towards my number of shareholders, so that they can understand what will be the scenarios. So if I'm talking to about two parts, we have basic EPS. So what is basic EPS? I will explain you diluted after some time. So when I talk to you about basic EPS, students will obviously have some formula. So they'll say, ma'am, with formula will do. Okay, formula is important. But before going to the formula, we need to know the actual concepts. Yeah, we need to know, okay, what is the meaning. For example, if I just frame up one question for you guys. I don't know whether these things will be visible to you or not. Yeah, I would like to just frame up this question. Yeah, are you able to see this? Yeah. Okay, students. Yeah, let's read this question and let's try to solve this question. Okay. So there is a company that is known as a Flame company. Okay, the Flame is a company with as a paid up capital of some 1 lakh shares, cool, at $1 each, and the company is having something else also. Okay, what I can do is, okay, I can just like put it down. Okay, will that be fine? Okay, yeah. Or I can do one more thing. I can insert 2-3 pages only. Yeah. Okay, so students, just try to understand it. Yeah, this becomes important question just because we need to know the concepts, and I don't want us to like just go on with the normal stuffs without having the question. It's okay to just read the theory, but fine. Okay, so there is a company with a paid up share capital of 1 lakh shares at $1 each. So maybe if I'm telling you what is the equity shares, okay, yeah, equity shares I'm getting, like say 1 lakh shares. Okay, 1 lakh shares per share is $1. Okay, and 20%, 20,000, 10% redeemable preference shares. Means there are 20,000 shares, but which are preference shares. So are preference shares also included in the equity shares? Obviously no, ma'am. Big no. It's big no. We know that. Why? Because preference shares get the dividend or the portion of interest, but that is something, it's not the shareholder which is equivalent to equity. So they get 20,000 into $1 into 10%. So some of the other thing they'll get. In the questions they have presented, like the gross profit of the company is $2 lakhs, expenses are 50. The company has paid up the share and the dividend of 42%. Okay, so they have given, okay, we'll understand. And the tax rates are also estimated at $40,000. We have to calculate the basic EPS. So before I go ahead with the calculation of basic EPS, I should start understanding from where I need to get it. So I have to get the profits. So yeah, we can take like gross profit is equal to how much? So my gross profit is 2 lakhs. I will reduce the trading expenses out of it. So if I reduce 50k, so definitely I'm having 1 lakh 50. Is it enough? Ma'am, no, please reduce the preference dividend also. I have to reduce the preference shares dividend, which is basically 20,000 shares into $1 each into 10%, which comes up to be how much? Is it 2,000? Yeah. Yeah, it was 20, right? Yeah. So it's 20. Yeah, wait. I don't want the things to be very much like shabby. Yeah, it needs to be 20,000, right? Okay, 20,000. Yeah, into, yeah, so it is 2,000. So I have to reduce that also. What next I need to reduce? Ma'am, you have to reduce the taxes also. So yeah, even the taxes are appointed with us with the 40,000. So okay, if I reduce all those stuff, what am I getting? What am I getting it? So yeah, if I reduce it, I get profit, that is 108,000. Yeah. So I am ending up getting a profit of 108,000, and this is my PAT. This is profit attributable towards the equity shareholders. If this is my PAT, profit after tax, is equal to 108,000. What is my number of equity shares? What is my number of equity shares? Ma'am, 1 lakh. So what am I getting it? Yeah, is it like 108 cent? Yeah, 1.08 cent. Okay, students, this is very easy, right? This is very easy. So do we get like this only number of equity shares, or do we think like the number of equity shares can change? It can easily change, don't you think? Like, students, try to understand what equity shares you have issued on day one. Will that be exactly the same number at the year end also? Ma'am, not possible ही नहीं है. Why it's not possible? Ma'am, there will be so much of the people who will be purchasing more shares. I'll be selling shares, like the company will be selling shares. Yeah, so that means the company will be selling shares. Plus there could be a situation that the company will be buying back its own shares. Yeah, buying back its own shares. So there are a lot of transactions happening, right? So with what should be my denominator? So I got to know when calculating the basic EPS, I need to have a numerator. Numerator will be my PAT. That is, if I read the whole scenario, yeah, if I just read the whole scenario, it is understood as numerator means profit attributable to whom? Profit available for whom? Profit attributable to equity shareholders, clearly, specifically for only for them. So I can write profit attributable to equity shareholders, or some people say it as ordinary shareholders, yeah, equity shareholders. So that is a denominator, numerator. Then guys, what's the denominator? What's the denominator? Yeah, ma'am, we know number of shares. So I'll say never to say number of shares. Always called it as WANS. Weighted average number of shares. Yeah, weighted average number of shares. So it's weighted average number of shares. So how can I find the weighted average number of shares? Ma'am, I know like there could be a situation like whatever I thought in the day one, maybe that many shareholders will not be there at the year end for sure. Maybe there will be some numbers increasing, some numbers decreasing. So how will I get the weighted average number of shares? So yeah, for that now, let us do one small and the quick question, yeah, which is there, which will hardly take like 2 minutes for sure. Yeah, we can just do this question. It will not take so much of time. Yeah. So there is a company, I think it's visible, clearly visible. There is a company who is a listed company, is having the following details. For example, on 1st Jan 2007, the company was having a share capital of 1,70,000. So there were 1,70,000 shareholders. So these are the shares. In the current year, on 31st May, like Jan, Feb, March, April, May, okay, after 5 months. So after 5 months, the number of shares increased by 80. That means a total will be 250. So students, so there are 12 months. For 5 months, can you tell me how many number of shares were there? Ma'am, only 1,70,000 shares were there, correct? Then it increased gradually. For remaining how many months? For remaining 7 months, I am having how many? 2,50,000 shareholders. Agreed, agreed, agreed. So simple. Please calculate the WANS, weighted average number of shares. Students, I am telling you, please make like this. If the question comes, please make like this, because this will make our concepts very clear and without any error for sure. Okay. So when I want to like compare the weighted average number of shares, my formula turns around to be for initial 5 months, how many shares I'm having it, guys? So I can do like 1,70,000 into 5 by 12 plus 2,50,000 shares will be there for like remaining 7 by 12 months. So guys, have calcies in your hand. So definitely you will find this much shares. So definitely Baba, my shares will not be 250. My shares will be lesser than 250, which is 216. Clear, clear, clear. I'm trying to explain you fast. Getting it? Yes. Yes? Clear. Okay. Now, we have something else also to be learned. For example, if I'm talking to you about earnings per share, is there any which ways there is a chance, ma'am, that when I'm talking to you about earnings, is it something like if I'm having shares, okay, if I have issued shares, for example, and if I have issued shares, what will I get? Obviously, ma'am, you will get consideration. Obviously, ma'am, this is something which we need not say. Like if I'm issuing shares, I will get what? If I issue shares, my company, I'll get the consideration in cash or whatever it is, consideration. If I issue shares, what will happen? My number of shareholders will increase. Yes, agreed? It will increase, definitely, it has to increase. Can I tell you, without even getting consideration, without getting any consideration, can your number of shares increase in your company? You say, ma'am, are you mad? Who will purchase in free? Like, will the company be mad? Like, without consideration, yeah, without consideration, do you think the number of shares can increase? I want just yes or no. Yeah, it's a very clear, big yes. How, ma'am? How can the number increase? Like, I don't got money, so I didn't get money, so why will the number of shares increase? Like, no company is mad to issue it free. Have you heard the word of bonus shares? Yes, ma'am. If the company has announced, let's say the company has announced for every one share, for every 10 shares, the shareholder has, the company will issue 2 shares. Let's say the company is having, or the shareholders are totally having, let's say 5,000 shares. Oh my god, 5,000 shares. For every 10, if the company issues 2 shares, for every 5,000 shares, what do you think? How many free shares the company has to issue? How many free? Do 5,000 into 2, divide by 10, please get it. So the company has to issue 1,000 free shares. So now you will not get any earnings. So your PAT, profit after tax attributable to equity shares, will be same, but your weighted average number of shares will increase from 5,000 to 6,000 shares. Yes. So ma'am, you will say, for example, if this thing happened, for example, I have issued this bonus. Let's say if I issued this bonus on, let's say, on like my year starts from 1st Jan 2020 till 31st 12 2020. For example, just understand. If I issued this bonus, let's say on 1st April 2020, will I not apply, ma'am, the portion, like apportionment? Like, can I do like this, ma'am? Now the total number of months are 12 months. Initially for like April, May, June. Oh, sorry. April, May, June. No, sorry. Jan, Feb, March. Oh, Jan, Feb, March. 3 months. 3 months the company will be having 5,000 shares. And ma'am, for later 9 months it is 6,000 shares. Can I not do this, ma'am, weighted average? But ma'am, why you did 6,000 directly as weighted average? See, students, when we calculate weighted average, it's a clear-cut scenario. It's a clear-cut scenario that, please try to understand. It's a clear-cut scenario that you need to have this weighted average on the amount that you have received. When it is a normal shares, when it is a normal money, okay, when it's a normal consideration that you have got it. So you will utilize in the business for how many months we take that much shares. But if it is free, you don't get any consideration. You can divide it from day one only, and not just with day one, and not just from day one. Why? For that I'll explain you one concept. Yeah, I know you guys know that, but I just wanted to tell you. For here, I will take this for whole months and not this way. So we have 3 parts. Like we have bonus shares, free consideration. We have share split. Prior to many years, it was 1 share's value was $10. Now they told, for every 1 share, $10 will not be the value. For every 1 share, $1 will be the value. Means shares are split. $10 per share has been split into 10 shares of $1 each. That way. Okay, when you don't get money, but it's just that the number of shares increases and decreases. That's all. Okay. So over here, my responsibility is not just to book like this way for the current year. No, ma'am. Because if I do the comparison, for example, try to understand. Okay, this is your previous year. This is your current year. Okay, this is a previous year. This is a current year. For example, previous year's profit and current year's profits are same. Let's say 5 lakhs. Okay, 5 lakhs and 5 lakhs. Okay. I told you in the previous year, let's say my shareholders were, let's say, 1 lakh. In the current year also it was 1 lakh only. Yeah. But the company issued, like, for every 5 shares you guys held it, we'll give you 2 shares as bonus. So how many bonus shares would have been there? So you can do, like, multiply it, like 1 lakh into 2 divided by 5. Are you getting 40,000 as bonus shares? So yeah, obviously in the current year, my number of shares will be now like 1 lakh plus 0.40, like that, 40k, like 40k. Okay. Yeah, can it be like, can I write it like 1 lakh 40? Yeah. So if I divide it in the current year, well, let's say 1 lakh 40, yeah, if I get the basic EPS, basic earnings per share, is it this, ma'am? 5 lakh divided by 1 lakh shares, ma'am, it's 5 per share, 5 per share. Okay, here 5 lakhs divided by 1 lakh 40, ma'am, it's less, it's 3.57 per share. So what decisions I'll take? Okay, ma'am, in the current year now, the company has not performed well, ma'am. In the current year, the share price has, the EPS has decreased, the company has not performed well. So I'll give my own disclaimer. So yeah, is it fine if I compare, if I say in the current year the company has performed bad? No, you cannot say. Why? When the profits are same, it's just because of the bonus. So this bonus, you need to restate it. Yeah, it's supposed to be restated. so that comparisons can be made equally. So restate means for comparison purpose, even these 40k you have to transfer it to previous year, means think as if these shares are issued from previous year, so that what comparison it can come. That means guys, try to understand it. Yeah, try to understand it. Yeah, so this becomes same over here. Yeah, I'll just put it over here in the current year also, when I'm doing the restatement. Okay, I'm doing the restatement. Yeah, this is current year. 5 lakhs was the profits. In the previous year, what happened? Previous year also you have to restate it. Ma'am, profit was same, but I used to restate my, yeah, so it's like 1 lakh 40. Over here also now it will be 1 lakhs plus 40. So if you take it, you would be 1 lakh 40. So even there you will be getting 3.57. So that now you can compare it. Okay, Baba, it is not because of the company has not performed well. It's not because of the company has performed bad. No, it's not just because of that. Okay, it's not because of that. It's just because the company has issued something. The company has issued bonus. Yeah. So you cannot deny that the company has performed bad. No, not that. Clear, clear, clear. I hope the things are very clear. Yeah. I think, yeah, we are clear with this. I'll just transfer it to here. Yeah. Yeah. Cool, cool, cool. I am pretty sure that you guys would have understood it for sure. Can we move ahead? Can we move ahead? Yes. Chalo, we can just move ahead. But yeah, the things will be very easy. The things are very easy. Okay. Then we have one more concept which is known as right issues. So what is the meaning of right issues? There are certain companies. Okay. Yeah. We have a concept of right issues. Like students, there are certain companies who have already their shareholders, but they want some of the shareholders to get more benefits. To whom they want to give more benefits? Let's say they want to give more benefits to some of which shareholders, like they can give like that way. For example, my existing shareholders, for example, if they want to give the benefits, like how they'll tell, okay, today my share price in the market at, let's say, $11. I want you, if you want, you can take my share price at something like a reduced price. You can take some shares at a reduced price. So how much reduced price they'll give? Okay, they told that now you are not supposed to like pay 11 per share. Okay, if you want, you pay something around like lesser. So how much they told? If you want, you just pay, or you just have an exercise price of $5. Okay, they told instead of paying 11 per share, you just pay 5 and yeah, take the shares. So what happened eventually on the date, on the opening date, for example, my shares are how much? Let's say on 1/1/2020, let's say my number of shares on the opening day, or my number of shares, let's say we'll consider how much? Let's consider 5 lakhs. Okay, my number of shares are, let's say, 5 lakhs. What I did it, I tried. The company has announced right share, so they told for every for every 5 shares you are having it, you get 1 share. Okay, the company announced on which date? Let's say they announced on 1st March 2020, like after 2 months. Students, this is important, huh? Please, this is important. We just cannot ignore it. The question is so big, so the solution is obviously going to be very big. So on this, they announced for 1 share for every 5 held, 1 share. So how much? 5? I have 5 lakhs. So how much shares? Obviously 1 lakh shares will be my right shares. Clear? Yeah. So now they told, okay, please calculate the earnings per share. Let's say the current year's earnings per share. Yeah. Let's say my current year's profits, they have given profits. Let's say my profits are $1.5 million. Okay, cool. Forget about it right now. That. So what I will do for the first students, yeah. Have you heard the word theoretical X-right price? Yes. So over here, if it is given, so what do I think? Okay, for every 1 share which is normally traded in the market, I have to pay 11. But now if they have given me some reduced price, it is $5. So I have to understand like what will be a theoretical X right price, like an average price. So theoretical TERP, theoretical X rate price is equal to, we have to see what is the normal share price. So my normal share price is equal to, for one share is equal to 100. Sorry, for one share is equal to 11. So 11 plus how many new shares I have given. Okay. So they have told for every 5 you have to give one share. For every 5 you are supposed to give how much? Only one share. Seriously. So what will be the average? What will be the average? So if I say like this, will you agree like one share if it's 11, and if I say you like for the remaining shares you are obliged to pay how much? 5. Divide by how many shares are coming up with? Yeah, so if I just tell you 11 will be the value for normal shares are 5 lakh shares, normal shares into 5 lakh shares. So how much it is coming price, guys? 11 into 5 lakhs. Is it coming 55,000,000? Yeah. 55,000,000. And what are the right prices? So my right shares value is, like I have to understand how many shares, ma'am, per share they are giving it 5. And how many shares? 1 lakh shares total. Agreed? Yes. So 5 and 1 lakh shares. So 5 into 1 lakh. Am I getting 5 lakhs over here? Yeah. So my total value is over here, if you can check on, is it 60 lakhs? Yeah. 60 lakhs is the total value. Okay. Divide by how many shares am I having? I am not having, whether am I having 6 lakh shares? Yeah, I'll change it with different color only. Yeah. Am I having this 5 lakh shares and 1 lakh? Yeah. So my total shares are how much? Total shares are, let's say 6 lakhs. So if I divide it, this with this, what am I getting? Am I getting TERP at the rate of 10? So if you take up the average, guys, I get 10. If you take up the average, you get 10. Yes. So that is known as my theoretical X-rate price. I hope you guys are getting it. Yes. So you have a value, means normally what was the share price that you were having it and the number of shares, divide by what is the like plus add you have to do the extra right that you have issued it, divide by what is the total number of shares, you get the theoretical X-rate price. Now why am I understanding this theoretical X-rate price? Is it going to be helpful for me anywhere? So yes, we need to analyze for the current year. For the current year, again I told you that way. We have some bonus factor. Why bonus factor? Just understand it. When did I issue this price? I issued it on 1st 20 was my year, but I issued and announced it on 1/3/2020. Don't you think you have reduced some price? Is it not $6 something is free you have given? Yeah, $6 something free you have given. What is this free, guys? Yes. Is it something like the bonus element in it? Yes, ma'am. It's a bonus element with them. So how many months there was a bonus element? For how many months is it free? Is it free for every time? No, ma'am. So you have to see. Achha, normally how much shares I was having and how many shares I am having later on. Yes. So now students, please try to understand. Yeah, this becomes very, very, very important. Like I have to see what is my normal market price. So my normal market price over here per share is 11, and right now what you got was theoretical X-rate price, which is over here $10. Yeah, so you can take a ratio, means when the price should be 11, you have given them at $10. So there is some free element in it. So how will you calculate? First of all, so how many shares I'm having? First of all, let's try to understand. On 1 Jan 2020 it announced on 1st March. So there are 2 months where it is free, and afterwards your number of shares will increase. You remember the 12 months. Now out of this 12 months, 2 months are like, okay, you have that way 5 lakh shares only. But ma'am, for remaining 10 months I have 6 lakh shares. For 6 lakh shares I don't have any problem, because how much I have to pay? Like there's 6 lakhs. Value is cool. For this is my number of weighted average number of shares. But for 2 months, guys, for 2 months you need to know what was the market price, how many free elements you have given. When the market price was 11, you have given a theoretical X-rate price of 10. So you have to multiply to get a proper number, that is 11 by 12. Okay. So if I do it, it's like 5 lakhs into 11 by 10 divided by 2 months, so 2 by 12 plus 6 lakhs into 10 by 12. If you take up the total, guys, what are you getting it? What are you getting it? Yeah, please, I need to know. 5 lakhs into 11 by 10 into 2 by 12. Is it something around 91666 shares plus 6 lakhs into 10 by 12? Am I getting around like 5 lakhs? Yeah. Am I getting the shares equivalent to 591666? Yes. Now your total number of shares are never 6 lakhs. It will be this much shares. Yeah. So what you can take up the situation? What can be your earnings per share? Simple. Your EPS can be your profit upon the weighted average number of shares. I got the weighted average number of shares like 591666. What's my profit? Am I allotted? Yeah, I was written earlier. My current is profit is 15 lakhs, 1.5 millions. If I do 15 lakhs, oh, I'm so sorry. What's your per share, students? Please calculate it. Will you get 2.54 per share? Yes. Now this is a concept which we need to know about the right issues. Okay. After we completed the right issues, we have a concept which is known as diluted EPS. So what's the meaning of, guys, diluted EPS? Okay. So I'm having normally some equity shareholders and all. I'm having certain shareholders, options, warrants. I have given it to my shareholders, normal shareholders. Okay, that's cool. Beyond that, even I have given them an option of, if you want, you can convert it into equity also. Means, ma'am, there are certain convertible. Yes, again, if they have given certain convertible options, in future you can convert it. So if it is converted, don't you think your number of equity will increase? Yes, ma'am, it will increase. It will increase, but ma'am, there will be certain difference also. What difference? Try to understand. If your number of equity will increase, will not your expenses be reduced? Yeah. Because prior to any years, you have to pay what? Guys, I was supposed to pay them the preference dividend. If now it is converted into equity, maybe preference dividend I will not pay. So my profit will be increased. Yes. If your profit will be increased, whether your profit divided by the number of equity shares is increased, is it so much that what you are paying today, like a basic EPS, if that guys also get converted into equity shares, your equity like EPS will be reduced. If it is going to get reduced in upcoming future, then it is known as diluted EPS, and that needs to be reported by the company. I know with the words it becomes difficult for us to understand, but yeah, obviously we'll be having some questions, and yeah, obviously the things will be very easy. Okay, things will be very easy. Okay. What if I tell you that the company is having, let's say, the total earnings, profit available for the company, total earnings in the current year is, let's say, 175050. Okay, cool. Yeah, okay. I told you, let's say the tax rates are available at the rate of, let's say, 35%. It's on PAT. Let's say it's the earnings. Let's say it's the earnings of the company. Let's say it's the rate. I have told them this situation. Yeah, please try to understand it. Yeah, I am having this stuff, for example. Yeah, this is the, oh, I'm so sorry. Yeah, I gave you the statement. Okay, like $2 lakhs, yeah, sorry, $20 lakhs of 10% convertible loan stock converted in 1 year's time at the rate of 3 shares at the rate of $5 stock. So I need to know, like, in 1 year, if I feel like this many people will be converted, how many it will be converted? Like 20 lakh, 10% okay, will be converted in just 1 year, and because of that I have to pay them some shares. Yeah, ma'am. So that eventually means what, guys? That eventually means what? How many like, what do you think normally what was your normally preference share dividend? How much I was paying them? Ma'am, $20 lakhs, yeah, into 10%. So I was initially paying them 2 lakhs as my dividend And if it is converted, now this dividend will not be paid. That means in the current year you have to pay extra tax. Yeah, last time I paid last time this was an expenditure, so you paid less tax, but now ma'am this time you have to pay tax. So this is minus net of tax, that is 35%. So this is nothing other than, guys, it's our savings if it is getting converted. How much is my savings, students? If you do it 2 lakhs minus 35%, are you getting 1 lakh 30? Yeah ma'am. So my savings is 1 lakh 30. Cool. Okay. How many number of shares will increase? What is my equity number of shares? For $5 I have to give 3 shares. For $20 lakhs, how many shares will I give? Do the cross multiplication. Simple. 20 lakhs into 3 by 5. Is it like something around 12 lakh shares? Yeah. So if you take up the total, if you divide it that way, are you getting like something around 10.08? Yeah. The savings means savings. You have to check like this. Is it increase or decrease? So I can understand the word. If this is a situation, what is my incremental EPS because of this change? What is my incremental EPS? So savings divide by wins. So it comes to 1 lakh 30 divide by 12 lakhs, which comes into 10.8%. Clear, clear, clear. So yeah, this is the way we are supposed to do the diluted EPS also. And I hope you guys are clear with the concepts. Yeah, is it simple? Can I now just show you the situations? I try to understand it. Okay, so they have told for the normal EPS. Okay, I'll go ahead with the normal EPS. So my basic EPS is over here. It's a financial matrix which measures the profit attributable to ordinary shareholders. Ordinary means ordinary, simple, normal shareholders. It's calculated by dividing the profit for the period attributable to equity shareholder divides by weighted average number of shares. And I know you all know this stuff very well prior to what I'm explaining you. I know all of you must be knowing this all things. What's up next? What's the bonus issue? If the company makes the bonus issue, obviously the share capital will increase, but cash they will not get. Agreed? They will not get shares, or like they will not get cash. From where will they get cash? Means they don't have so much of earnings. Instead, they have to pay. For this purpose of calculating bonus, basic bonus, we have to treat them in such a way that we have to take the easiest way of taking the fractions, and we have to add from when, ma'am, we have to restate it from the previous year. We have to restate it, that is outstanding from the bonus issue. So number of bonus shares after issue and before issue is a fraction. Yes. Now what's right issue? So yeah ma'am, right issue we know. For example, there is a situation that already there are certain shareholders in the market, and if I want to issue more shares to the existing shareholders, so I can give them certain price which is lesser than what they normally get it. So in that also they have some bonus factor. Yeah. So a right issue is a share which is normally made at a less than full market price. That is, a right issue is therefore a combination of the characteristics of its full value plus some bonus issue. Like in the market, if it is $11, if I issue at $5, ma'am, something is free. Yeah, something is like bonus. Yes. As already seen, it's very easy to do it. So what I do, yeah, this is my bonus fraction. I explained you, yeah. In the prior question, it was like 11 divided by 10. So yeah, this is what? The market price upon the theoretical X right price. I get the bonus element in that. So that's a bonus factor. So yes, students. Up next we have DP, diluted earnings per share. For example, if some company is having some of the other ways which wants to get converted into, so it's basically the conversion of the potential ordinary shares such as options, convertible bonds, convertible preferentials. They want to get converted into EPS. So if they want to get converted into EPS, we need to know if they get converted into EPS, whether what EPS I'm having it today, my basic EPS, is it getting reduced? If yes, only report. If no, please don't report. So we are supposed to report only the dilutive portion and not the anti-dilutive portion. Cool? Yes. So we have to determine the weighted average number of shares outstanding and to calculate the basic EPS. Simple. How will I do? Ma'am, it's simple. We have to just identify and see what the diluted EPS is, calculate the potential effect, and try to solve it. Simple, 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 simple. So yeah, there will be certain analysis, and yeah, we have to do it. Why it's important? Because it's good for having the comparison. We can check peer-to-peer industry, consistency, and so on. Yes, students. With these, I have also completed the important concept of the concept which is known as ratio analysis. Okay. Over here, we are not going to present like for cash flow. Okay, if I want to just have a cash flow, it's also very simple. Like if it's cash flow, what is it? What is it? When I talk to you about cash flow, we know that cash flows are also bifurcated into three parts. What are those three parts? Yes, it's basically from three activities. It's operating activities. Yes, it's financing activities, and over here the midway is the investing activities. So yeah, so all these three activities which we have to bifurcate it. Yeah, so it is basically the operating, investing, and financing activity, and how their ability is there for the measurements. So yeah, then we have some theory, okay, how we'll go ahead with the financial and non-financial stuffs, which is something which you guys can read it. Okay, so over here, students, what my agenda was is almost completed. So initially I had made up a plan to do IFRS 15. So guys, if you check up, yeah, I'll just open one's PPT, or maybe the blank page also will work well for me. Yeah, just give me a minute. Just give me, students, 1 minute, huh? I want you all to know, I want you all to exactly know what are the situations that you are, okay, I'll just don't want this employee benefit. Employee benefit is already done with us. So I'll just take up a new slide. Sure. I want full screen, but it's not going. No, I want to save. Yeah. Okay, students. Now this becomes important. Okay. Now this is what I really want you all to have once a word. Okay. Just try to like read it for once. Just give me a minute. So yes, students, as it is our day 4th, and we have almost done with our agenda. So yeah, what was my agenda, students? What was my plan? Yeah, so I told you, you can check on the YouTube also that we have the important standards for us. So like it's just last 40 days pending and 35 days pending and 30 days pending for our exams. So what is my schedule? Like how should I manage my exams? So the first and the foremost thing is, please try to take up all the small standards, small but important standards. So yeah, again, if you want, I can give you the important standards list. So what are the important standards for me? Start doing it with first IAS. Yeah, what standard will you do? IAS 19. Start doing with IFRS 2. Then over here it's the employee benefit, because employee benefit, it's not there in the FR. So higher probability becomes that it can come up in our examination. IFRS 2, share-based payments. Students, it becomes important. Cool. Please do that way. You can manage that. Along with that, if you're planning up to do, you can start doing with IFRS 16. Yeah, that becomes leases. Again, one easy standard you can pick up, IS 38, intangibles. And along with that, please do IS 36, which is impairment. Yeah, then which standard becomes very important, students, for us? Yeah, if you are done with this, students, please don't forget IS 12, which people will say, ma'am, it's difficult, it's not difficult. It's the income tax one. Yeah. Up next, what do you think which is important? Yeah, then if you get some small standards, you can do it. Then students, we can touch up with IFRS 9, that is my financial instruments. Yeah. Meantime, students, read. We have to just have a read on the ethics. And I would lay, last today, please do consolidated questions. For doing the consolidated questions, it's already there in my YouTube. Okay, please do all the questions, and even this is there in the YouTube. You can figure it out. Even this is there in the YouTube. Yeah, even this is there in the YouTube. And along with that, I have put some 2-3 standards more in the YouTube. So yeah, IFRS 15, you can check it. You can check the ratios. So students, I really want you all to have all the stuffs so that it becomes important. And doing these small standards daily, on the daily basis, please try to do what? Please, like without fail, you have to practice what, guys? Yeah, without any fail, you have to practice the papers. You have to practice the mock papers. You have to practice the mock papers, and yeah, 2 of the beautiful mock papers are there, which are lined up, which is something I'm going to do it tomorrow and day after tomorrow. Already 1 or 2 mock papers I have did in the previous videos. So a lot of section B questions, yeah, section B questions, which are like 25 markers. I have already did it in the previous videos. So yeah, if someone is not checked, do check it. Yeah, a lot of conso questions are also did it in the previous videos, YouTube videos. So from there you can get the good knowledge, in which there is a higher probability of coming of financial position, maybe PNL, maybe cash flow, but yeah, it can be any which ways. But spreadsheet, yeah, students, this is easy to score marks. So please have a good focus. And yeah, for the day, I think like we have covered a lot of concepts. Like whatever I have planned up, we have did that. And students, if you guys have any sort of doubts, you can always contact Lakshya team. Yeah, that is for sure. And moving ahead, if you want, we can like do more questions, but I feel like the concepts we have covered it. So yeah, you can practice some questions, and if you have literally any doubts, we can obviously have a word. And yeah, students, with these, I am planning up to wrap the session for the day. Yeah, and obviously students, if you guys have any doubts, do contact me for sure. And from tomorrow, maybe our session will be a bit better, a big, because it is papers. And yeah, within 2 days we want to solve papers. So I'll give you some tips and tricks how to do the paper, and how to upcome with certain confidence, how to boost the confidence to write the paper. Okay, so yeah, with this, guys, take care, study well, see you soon. We'll be having more knowledge and more fun. Yeah, thank you so much.